Hey everyone, this is a bit of an addendum to our class last time in POS 499, Globalization and Political Change. So we did a number of things in class talking about globalization, trying to define globalization, talking about the origins of globalization, when globalization actually began. And what I was hoping to do at the close was talk a little bit about some of the institutional features of economic globalization and how they emerged over time. Particularly in the aftermath of World War II, we see a number of really important international organizations emerge to regulate and oversee the global economy. And those are particularly important to understand as we address questions of how exactly did this most recent phase of globalization happen. So this is going to be kind of a quick overview of those developments. And you might have been exposed to some of this if you've taken a course in international political economy. I go over some of this information in my international relations courses. So this might be review for some of you, but hopefully it's helpful review. So the question I want to talk about briefly here is, how did the global economy come to be? And a really important starting point is a conference that happens in Bretton Woods, New Hampshire, basically at the close of World War II. Starting in 1944, their work carried over into 1945. You're looking at most of the major powers, all of the major powers on the Allies side, and several kind of smaller powers, a few dozen countries, getting together to discuss what had happened, World War I, the interwar period, and then World War II, and to make plans for what the post-war world would look like. And there was general agreement at this conference in Bretton Woods, New Hampshire, that the underlying causes of the conflicts that we saw, particularly World War II, were economic. It had to do with the boom-bust cycles of capitalist economies and the domestic forces that they unleash when we see economic downturn, and how that can spill out into the international scene and the global economy. And so their goal was to establish some basic principles and some organizations to help manage the post-war economy. And this is really, in a lot of important ways, it's a starting point for the globalized economy that we see today. So what were their objectives? Basically three key objectives. The first was to draw down tariffs and other barriers to international trade that had emerged starting with the onset of the Great Depression and had continued through World War II. The total volume of international trade had shrunken considerably. It was basically a third of what it was prior to 1933 at the close of the war. And part of that was just that countries were focused on their war efforts and not necessarily producing and exporting goods. But a big part of that was policy. There were many countries, the United States included, that thought that the proper way to deal with the economic slowdown that we saw leading up to the Great Depression and then this drop-off in economic health of these countries was to protect their national producers and to establish barriers to trade from overseas producers, right? So protect your national economy and kind of guard it against these competitors from other countries. That meant that international trade had shrunken considerably. If you were a producer and you wanted to market your goods in other markets, it was going to be extremely costly for you to do so. And so just overall international trade had contracted. And the Bretton Woods conference organizers, the country representatives, the diplomats there, thought that this was problematic. They thought that trade could be a positive force both for opening up other markets for our domestic producers, but also establishing linkages between countries that would make it counterproductive to go to war with one another. So they wanted to bring down those barriers to trade, particularly tariffs. Also wanted to establish a stable global currency system. If you're going to engage in international trade, you have to have a pretty much universally agreed upon medium of exchange. And so that would be paper currency in some form. They had to decide what that would be. Ended up being the US dollar. And lastly, at this point, the close of World War II, Europe is destroyed, Japan is destroyed. Lots of reconstruction needs to take place. Lots of rebuilding needs to take place, and so they need to figure out a plan for dealing with that, because the infrastructure, economic infrastructure of these countries was pretty much decimated in the aftermath of World War II. And so if the global economy is going to start to grow again, you need to attend to that, rebuild infrastructure, rebuild bridges, railways, factories. Your domestic base of production needs to be rebuilt. So that's going to be a key part of this. So the steps that they take to address these issues are to create some pretty significant international organizations. The first is the International Monetary Fund. International Monetary Fund, at least at this stage, its role is going to be oversee the international monetary system and ensure that there is a stable, quote, reserve currency. A reserve currency refers to a currency that's viewed as relatively stable. It holds its value. It can be used for the purposes of international trade, right? So the US dollar, the euro, British pound, those sorts of things today would be considered reserve currencies because we trust that they're going to hold their value. We trust the countries that oversee the monetary policy related to the production and circulation of that currency. Something like, a currency from a very volatile, very unstable developing country is not going to be a stable reserve currency. So sometimes this is referred to as hard currency too. Countries want access to hard currency. So the International Monetary Fund is going to oversee this process. Also create something called the International Bank for Reconstruction and Development, or the IBRD. This is going to deal with reconstruction and development, primarily going to provide assistance to the areas destroyed in World War II. Also has this secondary mission of fostering development in underdeveloped regions of the world. The International Bank for Reconstruction and Development will eventually evolve into something called the World Bank Group. But at this point, it's just the IBRD. The IBRD still exists. It's now a sub-entity within that larger World Bank Group. And the World Bank Group has shifted its focus from the rebuilding to that secondary mission, initially secondary, now primary, of fostering development. And the last entity that they create is something called the Global Agreement on Tariffs and Trade. This is actually just a trade agreement. It's not an international organization. And the goal was initially to create an international trade organization, something called the ITO, that would oversee trade, international trade. That wasn't going to work. It was largely conservatives in the US Senate that blocked this and did not want to see it happen. And because the major power, the United States, was not going to participate, they opted to go forth with something a little less demanding, the Global Agreement on Tariffs and Trade, or the GATT. This is basically a trade agreement among partner countries, GATT members, to enable trade liberalization through cooperation and multilateral negotiation. And the goal is to draw down those tariffs and non-tariff barriers to trade. Okay, so those are the three major steps. Those are really, really significant steps taken at the Bretton Woods Conference. The long-term impacts of the Bretton Woods system are kind of expand beyond the scope of the initial missions of those organizations. So Europe was rebuilt pretty quickly with support from the International Bank for Reconstruction and Development, and also the Marshall Plan, which you've probably heard of. This massive influx of money to support rebuilding efforts and rebuilding the economies and infrastructure of the European countries. And so within 10 to 15 years, that rebuilding had basically happened in Europe. And so the IBRD morphs into the World Bank and has this broader mandate for global development and poverty alleviation. And that's what the World Bank does today, right, is focus on development, focus on poverty alleviation. They focus a lot of their efforts on pretty significant big money infrastructure projects. So electrification, building dams, building bridges, building roads, those sorts of things that developing countries just probably don't have access to the money to engage in those large-scale infrastructure projects. But they also do some work at kind of the local grassroots level too. So it's a pretty broad mandate. They have a lot of development dollars at their disposal, and it goes in a lot of different directions for a lot of different purposes. But that's their overarching mission, is development. The IMF, International Monetary Fund, this currency system that they create for international currency works for quite a while. Basically, the system that they set up is that the US dollar is going to be the medium of exchange for international trade, and the United States government agrees to back the US dollar in gold. So conceivably, if a central bank from a country was holding US dollars, they became uncertain in the value of that currency and wanted to exchange it for gold, they could do so. The United States government would pay them. And that's very successful. People trust the United States government. They think that they have the capacity to oversee this system. The United States government in the early 1970s realizes that this has actually worked too well. There are so many people holding US dollars around the world that if there was ever some sort of attempt to kind of cash in those US dollars for gold, they wouldn't be able to provide that. So the system essentially collapses in 1973. President of the United States, Richard Nixon, says we can't have this exchange rate system that we're basically underwriting. And so they replace this system with what is called a floating exchange rate system. You've been exposed to this if you've traveled abroad and you've exchanged your US dollars. Currencies fluctuate relative to one another. And what determines the value of a currency is both monetary policy, so how much a country is producing, how they're managing their money supply, but also demand. So in a lot of ways, this sounds kind of weird because we tend to think of currency, dollars and euros and yen and stuff like that. We tend to think of it as the medium that we use to purchase commodities. But in the present system, under this floating exchange rate system, currency is actually also a commodity itself, and its value will be determined by supply and demand. So if there are a lot of people that want to hold US dollars or want to hold euros, that affects the relative value of that currency. So with the collapse of this system in 1973, the IMF is left without a role, right? Its job was to oversee this system, and it morphs into a new role. What the IMF does, and what it continues to do today, is it acts as a lender of last resort for countries that are in financial crisis. Okay, so basically, if a country is having a very, very hard time gaining access to that international currency, gaining access to significant reserves of international currency so that they can engage in international trade, they can pay off debts to international creditors, whatever it might be, they can turn to the IMF and say, look, our central bank is almost out of hard currency. We need a one-time cash infusion of usually a very, very large amount of money, and the IMF will provide that. It usually provides it with strings attached, which are called conditionality. World Bank does the same thing. They will give countries very, very large development loans, but they do so with strings attached, saying that, okay, we'll give you this money. Here are the changes that we want to see in the way that you structure your economic system. The last major step of the Bretton Woods system was something called the GATT, right? And the GATT is incredibly successful at driving down barriers to global trade. And we see an enormous spike in global trade, overall volume of global trade, and an enormous drawing down of barriers to trade, like tariffs and other things. So the GATT, as a trade agreement, functions really, really well, and it morphs into an international organization, something called the World Trade Organization, in 1995. Okay, so that's a quick overview of what the outcomes of the Bretton Woods system are. So the state of global trade and finance today is significant. And this is one of the things that your book dealt with pretty considerably. The volume of trade in both goods and services, but also financial transactions, so just shifting money from one country to another, far surpasses any previous period in human history. It's a function of several things. It's a function of changes in policy that those organizations that we talked about were responsible for. It's a function of technology, right? It's easier to shift money. It's easier to have a base of operations as a multinational corporation in numerous countries throughout the world. So it's a function of a variety of things that have come together. But the key insight is that both in goods and services and in shifting money, financial transactions, this is an unsurpassed period in our overall volume of those types of transactions. We see an explosion of cross-border economic interaction, particularly in the last few decades, as certain forms of technology have come online. Internet communications, telecommunications, the prices dropped considerably. Shipping costs and the technologies that we use to ship goods over long distances, as they have increased and improved, as the price of transcontinental air travel has been driven down, as we've created global media empires and global financial firms that can facilitate interactions and provide information about interactions. So a variety of things come together to produce this explosion of cross-border economic interaction. And the key thing to keep in mind with all of this is that these major international organizations have had to craft the laws and the practices and the norms around that activity, right? These things don't just happen. They take work, and it takes representatives from different countries sitting down to reach agreement on what the practices are going to be in order for them to work. And we've seen breakdowns, right? But by and large, the process of that economic interaction, really creating a single global market, has been pretty steady and pretty significant without any major hangups. So that, in a lot of ways, explains where we are today in terms of trade and finance. And we can look at this. We can look at this over long periods of time, right? If you want to look at this over roughly 500 years, you can see that for the vast majority of human history, exports and imports were a tremendously small percentage of overall economic output. For the vast majority of human history, we're talking about 5%, 10%, and now we've reached a point where, with the most recent data, 2011, 2012, some 60% of world GDP is exports and imports, meaning things that we are shipping abroad, services that we are shipping abroad, and things that we are bringing in from other countries. That is really, really remarkable. What's even more remarkable, I think, is the movement of capital. So not necessarily goods or services, but just finance, right? These are money, investments, foreign direct investment, complex financial instruments in which people are investing. That, as a percentage of world GDP, has grown really, really significantly. This is information that's out of date, right? This only goes to 2005, but already you're seeing basically, 15 to 20% of the economy of world GDP is related to the movement of international capital, not necessarily selling a product, not necessarily selling a service, but just investment and the movement of money around the world. And by far the most striking area, I think, is the realm of currency speculation. Some of you may have heard of this. You might even kind of be aware of it. But there are entire markets devoted to pretty small fluctuations in the values of currencies relative to one another, right? So we talked about that floating exchange rate system and how it means that basically money, right, currency, becomes like another commodity, and its value is in part a function of supply and demand, in the same way that iPods and coffee cups are their value as a function of supply and demand. Well, money now operates in the same way. It's a commodity. And if it's a commodity that has value and that value fluctuates, that means that there's potential for investment. So there are now entire markets set up by individuals called currency speculators. And what they do is basically those minor fluctuations that you see in national currency values. So, say you went to Canada 2 years ago and you had to exchange your money, and the exchange rate was a certain value, and now you go, 2 weeks ago, and it's a different value. They play on those minor fluctuations in the values between currencies, right? Usually they do so on kind of a day-to-day basis. So it could be, a 1 penny, 2 penny, very small, 1 or 2% fluctuation in the exchange rate between two currencies, which if you're exchanging $100, right, that doesn't necessarily translate into any meaningful return on investment. But if you're doing this with billions, tens of billions of dollars at a time, then you can make significant money just on those minor fluctuations between the values of currency. So the ability, the technological ability to shift dollars and convert dollars and other currencies to different currencies that we want to invest in is driven in a lot of ways by technology. Right? These were things that we couldn't do 15 or 20 years ago. But now the estimates are, and these are only estimates because we can't really know, that in those foreign exchange markets, roughly $5.3 trillion daily is traded. And it has to be on that degree of volume if people are going to make money on this. So there have been some very, very famous investors who have made billions of dollars doing this, the most famous of which is a guy named George Soros. George Soros is well known, I think, mainly because of his involvement in American politics. If the Koch brothers are kind of, the super investors, the super campaign donation folks on the right, George Soros is the equivalent on the left. He's a billionaire, and he donates significant money to campaigns, usually of Democratic candidates. And his money, his fortune, was largely built on his incredible skill foreseeing changes in currency and how the currencies would change their value relative to one another. And so he would speculate, he would transfer his funds from one currency to another to take advantage of those fluctuations. And he was really, really good at it and became a billionaire doing so. So here are some of the top currency traders. By and large, these are banks, right? Banks engage in this sort of investment activity, and banks from throughout the world. We have Citibank as the largest, but you have Deutsche Bank and Barclays and JP Morgan, UBS, which is based in Switzerland, Bank of America, HSBC. So all of the major financial institutions, the global players in terms of banking and finance, are involved in this game and exchanging currency in pretty significant volumes. Citibank, the largest, 16% of the overall volume of currency trading they're responsible for. What are the most valued currencies? The United States dollar still reigns supreme. Basically, of the turnover in currency that happens daily, they're about 87% of the share. Followed by the euro, Japanese yen, pound sterling, Australian dollar. So the top 20 are usually linked to pretty solid economies, but by far, the top 5 are really where the vast majority of currency is being traded, and then it goes down from there, right? So what's clear is that there's an enormous amount of economic activity happening over and above national borders. And what we need to think about a little bit is how international organizations help to structure and facilitate that volume of economic interaction. So how do they do that? Basically, function in 2 roles. And we're not going to talk so much about the World Bank. We're not going to talk so much about development. We'll get into that a little bit later in the course. And a lot of the major kind of protests against globalization highlight the World Bank as an entity which is deeply problematic and we should resist against. And a lot of the protest movements, the alter globalization movement, views that as one of the main culprits. But specifically, we'll talk about the World Trade Organization and the International Monetary Fund in their contemporary roles, not their historical roles, but the things that they do today. So, key functions of the WTO. 162 member states. It's an international organization. It formed from the trade agreement, the GATT, in 1995, and it's a one-vote one country, one vote system. So each country gets one vote when the WTO is going to pass some sort of packaged trade agreement, right? Basically, it provides a setting, something called trade rounds, in which countries engage in multilateral negotiation. Countries get together, they craft trade agreements, and their goal traditionally has been eliminating tariffs and non-tariff barriers to trade. Each one of the WTO members agrees to grant every other WTO member most favored nation status. So, in theory, what that means is that these countries treat each other fundamentally equally. There is not, a disparity between how we treat goods coming from Japan versus how we treat goods coming from Belgium. There are a few exceptions to that, but by and large, WTO members, when they're engaged in trade with one another, have to treat each other equally. They can't create different categories for different goods coming from different countries. Okay. There are frequently disputes that emerge in which one WTO member will say that another WTO member is treating them unfairly or is engaged in some sort of unfair practice with regard to trade, which is having an adverse economic impact on the country that is making that claim. So the WTO has a dispute settlement mechanism. This is basically a setting in which trade disputes between member nations can be heard and resolutions can be reached. And the decision of the WTO in that case, when there's a dispute, is binding. This is really remarkable when you think about the larger context of human history. We now have an international organization, has wide membership, right? 162 member states out of, maybe 200 and something, right? Just over 200 sovereign states in the world. So the vast majority of the world's countries are involved. And instead of resolving their trade disputes through political posturing, saber rattling, threats, and public confrontation, we now have this more normalized setting in which individuals, representatives from these countries, bring their disputes, and a settlement is reached. Whereas, like in the course of human history, lots of trade disputes and economic disagreements have resulted in war. This has been a frequent occurrence where two countries come into conflict over some sort of good that they both want access to, or access to some sort of shipping route, and all of a sudden we're at war. So the WTO, in the grand span of human history, and the fact that we have a mechanism to resolve disputes, is pretty remarkable. Key functions of the IMF today, as I mentioned, even wider membership than the WTO, 188 countries. Its votes are apportioned by the share of the global economy that a country holds. So it's not a one country, one vote system. It's a little bit different. And the World Bank actually has this system as well. We'll talk about that in just a little bit. I'll show you what that looks like in terms of how votes and decisions are made. But basically, the purpose of the IMF is to provide short-term infusions of money to countries that are experiencing a currency crisis, to countries that have insufficient reserves of international currency to continue to engage in all of the different things that happen in the global economy. Engage in trade, make payments to creditors, things like that. And this is a loan. It's a short-term loan, and it's paid back with interest on a pretty rapid timetable. So as soon as you approach the IMF for a loan, they will lay out the terms under which you're going to pay it back, and it's usually they want it paid back pretty quickly. Okay. So a currency crisis is when serious doubt exists as to whether a country's central bank has sufficient foreign exchange to maintain the country's fixed exchange rate. So basically, a country is in serious problems ensuring that it has access to foreign currency and can engage in international trade. These loans are made with conditionality, right? So when you get a loan from the IMF, not only are you going to agree to the timetable on which you'll pay it back and the rate of interest that you'll pay, but usually you are agreeing to make pretty significant changes in your domestic economic policy. This is what people are referring to when you hear the term austerity. Oftentimes, if you are in a position where your economy is so unstable that you're approaching the IMF and asking for this short-term infusion of money, it means that your economy is very volatile, and there are structural issues with your economy that need to be dealt with. The biggest thing that IMF will do when they come into a country is they really scrutinize your spending. What are you spending money on? Where is the limited revenue that the country is getting going? Like, what types of social programs are you supporting? What types of investments are you making in your society? What types of regulatory apparatuses do you have in place that you need to support with government revenue? And if it looks to be unsustainable, then they will suggest cuts. And these could be cuts in social welfare payments, pensions, the amount of money that you're spending on healthcare or education. They view things very kind of black and white in terms of the balance sheet and what you have in your bank account and what you are spending money on, right? They do not want to see countries in a situation in which they are continuously coming back to the IMF and asking for more and more and more short-term infusions of money because they're spending too much. So that's what the IMF does. If you're in a situation where you are the leader of a country and you're calling up the IMF because you need their help, you're in a really serious situation. It is legitimately a lender of last resort. That's what they call it. So, as I said, the votes in the IMF and the World Bank are a function of the amount of the global economy that a country's economy represents, right? So you have a certain share of the global economy. Your GDP is a certain percentage of the overall global share of GDP, and that translates into the amount of voting power that you have in an entity like the IMF. So as you can see, the United States has 17% of global GDP, and that translates into 17% of the votes that the country holds in IMF decisions, right? The EU as a bloc constitutes 32% of the global economy and gets 32% of the votes, right? But keep in mind, the EU is made up of many, many different member states. The US is the largest single country share of GDP in the global economy. It's the largest single country share of voting power in the International Monetary Fund. Same thing with the World Bank. I was going to play in class a clip for you guys from some of the protests recently that happened in Greece. People are protesting the IMF. Basically, Greece found itself in a very, very difficult economic situation, starting after the great financial downturn that turned into an economic crisis in 2008, 2009. And Greece is in a very precarious financial situation and had approached the IMF to try to resolve that situation. And the IMF, the German government, European Union, basically have been working with the Greek government for a couple of years to try to figure out some way that they can keep the Greek economy afloat and also help to move them past this situation that they find themselves in economically. It has been very, very controversial because it has led to all of those things I talked about with conditionality attached to short-term infusions of cash. So Greece has gotten the money that it needed from major international organizations, but it has come at a cost of having to slash social spending, having to drastically reduce the amount that they spend on public infrastructure, having to cut the salaries of public workers, sometimes in half, having to cut payments made to pensioners who might have no other source of income. So it's been very, very disruptive and controversial. And this is a clip from a Greek protest in relation to the IMF. What's significant about Greece is that normally, up until the early 2000s, mid 2000s, when we were talking about IMF involvement in a country, we tended to be talking about very underdeveloped countries in sub-Saharan Africa, Latin America, countries that had been pretty significantly mismanaged. We weren't necessarily talking about relatively advanced, relatively developed countries in Western Europe. So that is pretty significant. And the situation in Greece has been an ongoing and problematic one. So if that's something you're interested in, kind of the popular response that the IMF can produce when it's involved in a country. Just do a search for Greek IMF protests. There have been pretty significant political impacts as a result of IMF involvement. Or if you want to look at a Latin American country, do Argentina IMF, just type it into YouTube, and you'll see basically anywhere the IMF goes, there's usually some sort of popular protest, some sort of response to the IMF. So why are these organizations so controversial? I've said a little bit about that, but in general, the world's most wealthy economies have significantly more power than the lesser developed countries. Sometimes that's explicit, like with the IMF and the World Bank. They have the same voting rules and voting system, which apportions power and decision-making based on one's share in the global economy. Sometimes it's less explicit. With the WTO, technically you're dealing with a system of one country, one vote, right? But the United States brings much, much more in terms of resources to shift and direct those negotiations and expertise. They'll come, with an army of trade representatives and lawyers and industry representatives, and they just come with kind of an entourage that developing country might not have. But they also have tremendous leverage, right? The size of one's economy gives you tremendous leverage in those negotiations over trade agreements, right? So even in an organization like the WTO, you have, with one country, one vote, you still have countries like the United States or Western Europe or Japan or Australia having much more power than underdeveloped countries. Also, the negotiations tend to be secretive, and critics have accused these types of organizations of ignoring issues, ignoring human rights or the environment or women's rights or the rights of indigenous people. The negotiations, the organizations would argue, have to be secretive because the type of sensitive information that's being shared, and countries have to operate in an environment in which they feel shielded from public scrutiny, given that they're talking about trade agreements and how their country is going to structure itself economically. But that has led to quite a bit of criticism and this argument that the agenda of these organizations focuses too much on economics and ignores the secondary issues. And also the conditionality of both IMF lending or World Bank lending, it can lead to really sudden and painful cuts in core aspects of a country's policy priorities, right? So things like pensions, education, social services, healthcare. When you start to cut those things, people find that problematic, right? To say the least. You can be literally kind of impacting people's ability to survive and continue to have a basic standard of living in the country where they live. So that can provoke mass unrest. This is also viewed as a violation of sovereignty. Sovereignty is the idea that states have an expectation of non-intervention in their domestic affairs. So if they are making domestic policy, some other power, some other entity can't step in and say to them, oh, no, you have to do it this way. And states take sovereignty pretty seriously. And what happens in these situations is that domestic policy is not made by the democratic decision makers within a country or that country's leaders, but it is literally dictated to those countries by these outside organizations. Now, these international organizations would say that has to be the case because we're engaging in risky lending to a country that's clearly in trouble. And the reason that they are in trouble is because they have made a series of poor decisions about structuring their economy. So we need to be able to present them with advice and have some leverage to get them to follow that advice. And it's not just the country who is at stake, but the fate of the entire global economy. So it actually extends beyond mere domestic policy. If one economy collapses, then it can have ripple impacts throughout the entirety of the global economy. So we need actually to kind of override the sovereignty of nations in certain instances when it has this larger impact. I think we've seen some of the dangers of global economic interdependence recently. Obviously, a situation in which trade and finance have become so global in scope kind of brings us together And we talk a lot about interdependence, the linkages between countries throughout the world, but it also brings with it tremendous risks. The first real instance of a rapid global crisis in the globalized era that we saw was what's called the 1997 East Asian crisis. Basically, going back to that idea of currency speculation, there was a perception in 1997 that the currency of Thailand, Thai baht, was overvalued. It had risen in value, it was overvalued, and it was going to sink in value. And so the currency speculators and investors that were holding this currency began to get rid of it because they wanted to get rid of it before that overinflated currency started to sink and they would lose money on their investment. And so major investors who were holding lots and lots of Thai baht began to dump it, get rid of it. And it's just like anything. It's like the stock market. You know, if everybody's getting rid of a stock, there becomes this kind of herd mentality in which more people want to get rid of it, and all of a sudden nobody is holding this currency anymore, and it's rapidly losing value. Right? That was what happened with the Thai baht. The problem was it started spreading to concerns about the entirety of the East Asian economy, so South Korea, Philippines, Indonesia, other countries, saying, okay, maybe all of our investments in East Asia are problematic, and so this quickly spread from one country to another, and then spread to major trading partners. So Russia starts to be affected, and then major trading partners with Russia in Latin America start to be affected, and it looked like it was just going to kind of envelop the entire world. Eventually what happened was buyback of some of those resources that had lost tremendous value, and a coordinated effort at the global level to ensure that this crisis came to an end. But lots of countries were affected, and not just in terms of their currency, but in terms of domestic economic concerns, right? So that was the first one that we saw. And then the most recent one, in which some of those more dangerous, more consequential elements were not averted, was the global financial crisis in 2008, 2009, where really the impetus for that, and I think Steger does a good job of pointing this out, the impetus for the global financial crisis was these complex financial instruments called mortgage-based securities. They were rooted in basically predatory lending in the United States, people who were given mortgages who never would have been able to qualify for those mortgages. And they were packaged up into complex financial instruments called mortgage-backed securities. They were given positive ratings by the major rating agencies that assess things based on risk. And they were sold to banks and financial institutions throughout the world. So now globally, this risk has been distributed. And the root of it was some really dodgy investments and some expectations of repayment that never should have been made by a handful of financiers and lending houses, right? So if you think of 2008 to 2009 and what transpired afterwards, it was really devastating. And here you have some numbers on what the overall impact ended up being. A massive, massive bailout, tremendous amount of value that was wiped out. Just, companies' value was wiped out by the financial crisis. You had, at the same time, the United States was bailing out banks and financial lending institutions that were deemed too big to fail. Same thing was going on in Europe. They had their own bailout. And really, in terms of the overall impact on the global economy, it was severe. It took years to recover. In particular, the finance industry took years to reopen lines to credit that became closed as they were concerned about their overall financial health. Credit was kind of frozen for a while. And the key purpose of the bailout was to unfreeze credit so people that relied upon credit could get access to it again. So this, I think, shows us the dangers of economic interdependence. There's a few quotes here. This one is a guy named John Husted. He's a state rep from Ohio. And he says, we as a nation have $9.5 trillion in debt. This is $31,500 per consumer. We have a consumer debt that is $8,300 per capita. That is crippling our economy as a result. We've witnessed irresponsible lending as a major factor in slowing our economy. It's not just consumers, but it's very large banks and firms on Wall Street, right? So that gives you a sense there of the consumer level and also firm level decisions that we're making in terms of economics, right? The issue there is that those decisions no longer just impact the health of our domestic economy, but they have a ripple effect. Particularly, they have a ripple effect when banks and lending institutions are packaging up that consumer debt and distributing it outward, right? So other banks and financial institutions throughout the world are purchasing that debt. Economist Paul Krugman, from the other side of the political spectrum, says what we know now and what should have been obvious even at the time was that the surface stability of the U.S. economy rested upon an unsustainable rise in debt. In retrospect, the complacency of both policymakers and investors in the face of the trend visible in this chart, he's referring to the charts on the previous page, is remarkable. Why weren't alarm bells ringing? Right? So, global economic interdependence has tremendous impacts, some of them quite positive. The one avoidable one is that it increases every country and every individual's exposure to risk. We talked about, as we define globalization, it's an increase in the volume of interaction, the speed of interaction, and the distance over which interaction happens. This is one such instance, right? Risk has been distributed globally in ways that it really has not been previously in our economic history. We have never seen this degree of tightly interwound interdependence and the relationships that we're bound by with regard to our shared exposure to risk at this level in human history. So, why this matters? One, the processes of globalization have brought us into interdependence. The U.S., relative to other countries in the world, wields enormous power, both because of its domestic economy, which, as you saw, is roughly 17% of global GDP, by far the biggest percentage of global GDP, and its power in international organizations. The United States, by and large, can block or facilitate things from happening at organizations like the IMF or the WTO or the World Bank. So that gives us, the third point, a very important leadership role in trying to navigate the global economy through that sea of risk, through policy and through crafting agreements at the international level. It also means that the U.S. is a lightning rod for criticism. And that's something we're really going to get into in the second half of the class, is when people think about these larger trends of economic globalization and what they are frustrated with about them. They are not just thinking about globalization, the abstract concept. They are seeing the United States as the driver for the things that they find frustrating with economic globalization. So if it's an unjust distribution of wealth, or institutions that they view as rigged, or trade practices that they feel give powerful countries an unfair advantage, whatever it might be, labor concerns, human rights, environmental concerns, they are looking at the United States probably with some sense of blame and complicity for what they view to be problematic. So these are themes that we'll get into much more in the second half of the class. But the key thing that I want you to keep in mind is that economic globalization isn't just a process that unfolds without our involvement. And the past 60 years or so has been a very conscious, very strategic, and systematic attempt to create that interdependence that now exists. But it's not inevitable that it would just unfold. And had these organizations not been created in the aftermath of World War II, it probably would not have unfolded, right? We would have needed to create some sort of oversight, some sort of regulator, some sort of facilitator to make this process move forward. Okay, so might have been review in certain respects, but hopefully it's helpful review and it provides a good foundation for what follows in the class. So I'll wrap up there and see you guys next week. Thanks.